Welcome. Today we're diving into the world of investing, specifically designed for beginners. If you've ever wondered how to make your money work for you or felt overwhelmed by all the financial jargon, this video is your step-by-step blueprint. We'll break down the basics, walk through real-life examples, and give you practical scripts you can use to start your journey. Whether your goal is financial freedom, building wealth, or simply understanding how money really works, you're in the right place. Let's start by laying a solid foundation and shifting your mindset about what investing truly means. Most beginners think investing is all about picking stocks, but here's the truth. Investing is about turning your active income into asset income. It's about converting your time into ownership and making your money produce even more money. This mindset shift is crucial. Instead of just working for money, you want your money to start working for you. This is the first step toward true financial independence. Let's explore the different types of income and how wealthy people use them to their advantage. There are four main types of income you need to know: earned income, business income, portfolio income, and passive income. Earned income is what you get from your job or salary. Business income comes from running a business. Portfolio income is generated from investments like stocks, ETFs, and bonds. Finally, passive income flows in from assets like real estate, royalties, or dividends. The wealthy focus on shifting from earned income to asset income, allowing their money to grow even when they're not actively working. Let's introduce a simple but powerful formula. Wealth equals income minus expenses times time times rate of return. This means the money you keep after expenses, multiplied by how long you invest it, and the rate at which it grows determines your wealth. For example, if you earn $3,000 a month, spend $2,500 and invest the remaining $500, you're already on your way. The longer you invest and the better your returns, the more your wealth compounds over time. Compound growth is the secret sauce of investing. Imagine you invest $10,000 at an 8% annual return. In the first year, you'll have $10,800. By the second year, it grows to $11,664. Fast forward to year 10, and you're at about $21,589. By year 30, it's over $100,000. Compounding is exponential, not linear. The first 10 years may feel slow, but the last 10 years can feel almost magical as your money starts to grow on its own. Before you start investing, it's essential to fix your financial foundation. Think of this as building a house. You need a strong base before adding anything on top. This means having an emergency fund, eliminating high-interest debt, and making sure your basic financial needs are covered. Only then can you confidently invest for the long term without worrying about unexpected setbacks. An emergency fund is your financial safety net. Aim to save 3 to 6 months' worth of living expenses. For example, if your monthly expenses are $2,000, your emergency fund should be between $6,000 and $12,000. This fund protects you from having to sell investments at a loss if something unexpected happens, like a car breakdown or medical emergency. Keep your emergency fund in a high-yield savings account or a money market account for easy access and safety. Imagine your car breaks down unexpectedly. Without an emergency fund, you might have to sell your investments at a bad time, potentially losing money. With an emergency fund in place, you can cover these costs without touching your investments. This simple step keeps your long-term financial plan on track, no matter what life throws your way. Your emergency fund should be both safe and accessible. The best places are high-yield savings accounts or money market accounts. These options offer better interest rates than regular savings accounts and allow you to access your money quickly when needed. Avoid investing your emergency fund in stocks or other volatile assets, as you want this money to be there when you need it most. For investing, it's crucial to eliminate high-interest debt, like credit cards. These debts can quickly eat away at your financial progress because the interest you pay often outweighs any investment gains. Focus on paying off these debts first. Once you're debt-free, you'll have more money to invest and grow your wealth. An effective way to eliminate debt is the debt snowball method. Start by paying off your smallest debts first, while making minimum payments on the rest. As you pay off each debt, roll that payment into the next smallest debt. This creates momentum and keeps you motivated as you see progress. Once your high-interest debts are gone, you can redirect those payments into your investments. Another approach is the debt avalanche method. Here, you focus on paying off the debt with the highest interest rate first, while making minimum payments on the rest. This method saves you the most money in interest over time. Choose the method that works best for your personality and situation. The key is to become debt-free as soon as possible. Insurance is another crucial part of your financial foundation. It protects you from unexpected events that could derail your progress. Make sure you have adequate health, auto and renters or homeowners insurance. This way you're covered if something goes wrong, and you won't have to dip into your investments to cover large expenses. Imagine facing a major medical bill or car accident without insurance. The costs could wipe out your savings and investments. Insurance acts as a safety net, allowing you to recover from setbacks without derailing your financial goals. It's a small price to pay for peace of mind and long-term security. Growth mindset is essential for successful investing. This means believing that you can learn, adapt, and improve over time. Mistakes and setbacks are part of the journey, not reasons to give up. Stay curious, keep learning, and remember that every investor starts as a beginner. Your mindset will shape your financial future. Before you invest, set clear financial goals. Do you want to buy a home, retire early, or travel the world? Knowing your goals helps you choose the right investment strategy and stay motivated. Write down your goals and review them regularly to track your progress and stay focused. It's important to distinguish between short-term and long-term goals. Short-term goals might include building an emergency fund or saving for a vacation. Long-term goals could be buying a house or retiring comfortably. Your investment strategy will differ depending on your timeline, so be clear about what you want to achieve and when. Budgeting is the foundation of any financial plan. Track your income and expenses to see where your money goes each month. This helps you find areas to cut back and increase your savings rate. Use budgeting tools or apps to make the process easier and more effective. One of the easiest ways to save consistently is to automate your savings. Set up automatic transfers from your checking account to your savings or investment accounts. This way, you pay yourself first and make saving a habit, not an afterthought. Tracking your net worth helps you see your financial progress over time. Net worth is simply your assets minus your liabilities. Update your net worth regularly to stay motivated and make informed decisions about your money. You don't need a lot of money to start investing. Even small amounts add up over time thanks to compound growth. The key is to start now, no matter how little you can invest. Over time, your contributions and returns will grow, helping you reach your financial goals. All investments carry some level of risk. Understanding your risk tolerance is crucial. Some people are comfortable with more risk for high returns, while others prefer safety and stability. Assess your comfort level and choose investments that match your risk profile. Diversification means spreading your investments across different assets to reduce risk. Don't put all your eggs in one basket. By investing in a mix of stocks, bonds, and real estate, you protect yourself from big losses if one investment doesn't perform well. Asset allocation is about deciding how much of your money to put into different types of investments, like stocks, bonds, and cash. Your allocation should reflect your goals, risk tolerance, and time horizon. Younger investors can often take more risk, while those nearing retirement may want more stability. Stocks represent ownership in a company and offer higher potential returns, but also more risk. Bonds are loans to companies or governments and provide more stable, but lower returns. A balanced portfolio often includes both to manage risk and reward. Index funds and ETFs are great options for beginners. They allow you to invest in a broad range of companies with just one purchase, providing instant diversification. They also tend to have lower fees than actively managed funds, making them a cost-effective way to grow your wealth. Real estate can be a powerful way to build wealth. You can invest directly by buying property, or indirectly through real estate investment trusts, REITs. Real estate offers passive income, tax benefits, and long-term appreciation, making it a valuable addition to your portfolio. Take advantage of tax-advantaged accounts like IRAs and 401(k)s. These accounts let your investments grow tax-free or tax-deferred, helping you build wealth faster. Contribute as much as you can to these accounts to maximize your long-term growth. Investment fees can eat into your returns over time. Be aware of management fees, trading commissions, and expense ratios. Even small fees add up over decades, so choose low-cost investment options whenever possible. Behavioral finance studies how emotions and psychology affect our financial decisions. Fear and greed can lead to poor choices, like panic selling or chasing hot stocks. Recognize these biases and stick to your plan, even when the market gets volatile. Dollar cost averaging means investing a fixed amount of money at regular intervals. regardless of market conditions. This strategy reduces the impact of market volatility and helps you build wealth steadily over time. It's a great way to take the emotion out of investing. Over time, your investments may drift from your target allocation. Rebalancing means adjusting your portfolio to maintain your desired mix of assets. This keeps your risk level consistent and helps you stay on track with your goals. Investing for retirement is one of the most important financial goals. Start as early as possible to take advantage of compound growth. Use retirement accounts like IRAs and 401(k)s and aim to increase your contributions over time as your income grows. You can also invest for your children's future through accounts like 529 college, savings plans, or custodial accounts. Starting early gives your kids a huge advantage, thanks to the power of compounding. Teach them the basics of money and investing as they grow. Be cautious of investment scams and promises of guaranteed high returns. If something sounds too good to be true, it probably is. Always do your research and stick to reputable investment options. Every investor makes mistakes. The key is to learn from them and keep moving forward. Don't let setbacks discourage you. Use them as opportunities to improve your strategy and grow as an investor. The world of investing is always changing. Stay curious and keep learning. Read books, follow reputable financial news, and consider taking courses to deepen your knowledge. The more you learn, the better your decisions will be. A mentor can help you avoid common mistakes and accelerate your learning. Look for someone with experience who is willing to share their insights. Don't be afraid to ask questions and seek guidance as you build your investing skills. Consistency is key to long-term investing success. Stick to your plan, keep investing regularly, and avoid making emotional decisions based on market ups and downs. Over time, your discipline will pay off. Regularly review your investments and financial goals. Make adjustments as needed, but avoid overreacting to short-term market changes. Stay focused on your long-term objectives and celebrate your progress along the way. Wealth building is a marathon, not a sprint. Focus on making steady progress rather than chasing quick wins. Over time, your consistent efforts will compound, leading to significant financial growth and security. Take time to celebrate your financial milestones, whether it's paying off debt, reaching a savings goal, or making your first investment. Recognizing your achievements keeps you motivated and reinforces positive habits. As you build wealth, consider ways to give back to your community. Whether it's through charitable donations, volunteering, or mentoring others, giving back creates a positive impact and adds meaning to your financial journey. Surround yourself with positive influences and stay inspired on your financial journey. Follow successful investors, join supportive communities, and keep your vision clear. Inspiration fuels your motivation and helps you overcome challenges. Remember, investing is a lifelong journey. Start with the basics, keep learning, and stay committed to your goals. With patience, discipline, and the right mindset, you can achieve financial freedom and personal growth. Your future self will thank you for taking the first step today.